Hello, everyone, and welcome to another session. In this session, I am starting with a new topic, working capital management. Now, this is there also in ACCA, also there in CA financial management, also there in uh, CMA, and also there in CS, executive, corporate accounting, and financial management. The concept remains the same. The questions can be different. See, first of all, working capital management, when we talk about, it is not just managing one asset or one liability. It includes managing the entire components of working capital. It includes managing cash. What is working capital? Current assets minus current liabilities. So we have to manage each one of them. It includes managing cash, accounts receivable, inventory, marketable securities. It also includes managing accounts payable. So different companies opt for different strategies in managing working capital. Some companies go for conservative working capital where they have sufficient amount of cash, inventory and AR. Some companies go for aggressive working capital management strategies where everything is kept to a minimum. Investment in the entire working capital is kept to a minimum. So let's look at it. First, cash management. First of all, there are three reasons why a business holds cash. And remember this because this is very common in the questions as well. So there are three motives on why a business holds on to cash. First, transactional. Transactional means to do transaction. Everyday transactions occur with cash only. You need cash to pay salaries. You need cash for meeting other day-to-day operations of the enterprise. Second is precautionary. Precautionary means as a means of precaution. You hold on to cash because in some periods, especially during the business, you need more cash because it's a busy season. You need more cash. You have hired more people. You need more materials. You need more. You create more debtors. Anything. So you hold more cash. So this is the precautionary motive for holding cash. Just like our homes, we hold cash now in our bank accounts, but we hold money in our bank accounts for precaution, for uncertain times. And third is the speculative motive. Speculative means if any opportunity presents itself, we can take advantage of the same. If anybody is selling anything at a cheaper price, we need cash to take advantage of them. So first of all, there are three primary reasons for holding cash. As highlighted, is transactional, precautionary, and speculative, and their goals are different. Transactional generally is for a medium of exchange. Cash is the primary medium of exchange that we use. Precautionary as a form of reserve for uncertain times, contingency, and speculative to take advantage if any unexpected opportunities present itself. What should be the firm's optimum level of cash is determined generally by a cost benefit analysis. See, cash in itself gives you no return. So only the amount that is required to satisfy current obligation should be kept. Because cash is not going to give you any return. The fund should be kept in a return bearing instrument. Can be a bank account, checking, savings, anything, or can be a money market instrument. And remember, whatever is your motives for holding cash, that has to be compared against the opportunity cost of missed investments in marketable securities. Because you are holding cash, you are not able to invest your money in short-term marketable securities, which gives some interest. So there is an opportunity cost involved. So whatever is the expected return on available investment projects, they must be the greater return on investments of comparable risk. This is also a very vital line, that whatever you are expecting to earn should be greater than the comparable risk projects. So there are, again, for your benefit, there are three primary reasons for holding cash: transactional, precautionary, and speculative. And the optimum level of firm's cash position is generally determined by a cost benefit analysis, where you see what is the net benefit by holding cash and you compare it with the cost. Now, companies generally have two strategies. First, they want their cash to come in quickly. So whatever is the cash that is receivable, they want it to come as quickly as possible. And their cash payments, they want it to go as low as possible. So first you want to speed up the cash collections. The period from which a payer mails a check until the funds are available in the pay's bank is called float. Means the time taken from when the my debtor mails me a check until the time the funds are cleared and deposited in my account. This time is called float, collection float. Firms use various strategies to decrease this time, because if this time is decreased, money will come quickly to my account. Now, how do I calculate? We simply calculate daily cash receipts into days of reduced float. So if my average daily cash collection is 1 lakh 50 and I am able to reduce it by 2 days, my average cash balance will increase by $1,50,000 into 3 lakh dollars. And that I will compare with the opportunity cost of funds, because that much I will be able to earn through this. And the benefit of any plan, again, has to be greater than the cost. Otherwise, it's of no use undertaking it. The benefit is $20,000, the cost is $25,000. I should not take up any such plan, because it will lead to reduction only in my net operating income. One of the most popular ways that companies use is lockbox system. Customers submit their payments to a mailbox rather than to the company's offices. So instead of submitting it to the company's offices, they submit it to a mailbox. Bank personnel will directly go and remove those checks from the mailbox and deposit them to the firm's account immediately. So time is saved. They would have given me the check. I would have processed the check. I would have then deposited the check. Then the money would have got credited into my account. In this case, bank people are directly with taking the check from that designated mailbox and depositing it to my account. So in this case, funds are getting cleared quickly. Generally, bank charges a flat monthly fee for this service. Bank will charge you a fees for this service because it is providing you this service. The people will go, they will, from that mailbox, they will collect the checks for your accounts, they will deposit them directly. Your float reduces. Of course, bank will charge you a service for this. So what is lockbox system? Lockbox system appropriately means customers will generally deposit checks instead of to your offices or mailing it to your offices, will directly deposit it to that bank designated lockbox. Bank will directly collect the checks from that lockbox and will deposit it to your account. Money will come in quickly, maybe by 2 days, maybe by 3 days. Any company which is doing business nationwide, a lockbox system is a very, very appropriate way of accounting. Second, and another very common way of doing this is concentration banking. Concentration banking means customers will submit their payments to a local branch office. Of, then the branch office will deposit the funds to a local bank account. So whatever is my local branch there of the business, customers will submit the checks there. They will then deposit it to the local bank account, and then the funds will be transferred at one concentration account, maybe whichever is the firm's main bank. Again, I can speed up cash collections because it would have taken time for them to wire up the or send the checks to my head office, from where if I deposit again to the bank, there is lot of collection float involved, so it will save time. Third, in India we call it IMPS or RTGS. In US they call it wire transfer, or UK also they call it wire transfer, transferring funds by through wire. Immediately you can receive the funds, electronic funds transfer. So first, these are the three most common ways of speeding up your cash collections. Just revise once. First is lockbox system. In this, the company, that is my debtor, instead of mailing checks to my address, they will deposit it to a designated lockbox of the bank. Bank people will collect the checks from that lockbox and will deposit the checks to the customer's account, thereby reducing the time. Second is, and for lockbox, bank charges a flat concentration fees. Second is concentration banking, in which my debtor generally deposits the checks to one of my local branch offices. My local branch office will then deposit it to my one of the local bank branches. And then my funds will be transferred to one of my principal banks. Third, wire transfer. Immediately the receipt of funds, electronic funds transfer.